Are you a high-yield income investor using covered call ETFs and already asking yourself questions like, does fluctuating NAV impact my distributions? Or how does a reverse split impact my book NAV? Or when should I DCA reinvest on one of my ETFs and when should I stop? Or even what does it mean for one of my ETFs to reach that beloved house money status? If these questions sound familiar, you are exactly where you need to be. In this video, I'm tackling all of them and more as part of my first fireside chat with my fast-growing PIIverse Income Investing community. So, grab a coffee, sit by the fireside with me, and let's talk. Hello again. So my name's Perry, and welcome to the PIIverse. This is my one channel on high yield income investing. I know I got several, I'll say thousands of subscribers because I'm very close. I'm 100 away from the big 10,000, but thank you for all those that have subscribed to me already. And I know this community is growing a lot. And that's why I'm actually doing this as my first ever fireside chat, because as the community grows and over the last 3 months, the questions on all my growing number of videos keeps growing as well. A lot of you are asking questions in several areas, like on the comments, you're sending me private messages, you're sending it to me in Blossom. There's just several areas where I'm getting a lot of comments and a lot of questions, some misinformation that I hear on some of them. So what I decided to do is, instead of having one video that basically tackles one question and everyone keeps asking me, can you ask me a question on this? Can you do it on this one? I decided to do it as a fireside chat. Now, maybe once I get good with technology and keep trying to come up with more creative ideas, I will actually build a fake fireplace behind me and we can actually sit by the fireplace. But for now, all you're going to get is that fake fire up there on the little window. and we're going to tackle these together. So grab a coffee. I will put all of these questions in chapters. So again, those that know my videos know I'm very long-winded and my videos usually last a long time. So when you get bored of one question, just use the chapters that are in the bottom of the video and you can flip from question to question. I will be tackling 10 topics. And likely while I'm tackling them, couple others are going to start showing up because I know this is going to be a very impromptu thing. I'm just going to be running the way I do. So let's get started. The first thing I need to do, sometimes I forget to do this, but I will put it in the disclaimer in my description. But anyways, let's start this right away. So my first thing is a disclaimer. I am not a certified investment or tax expert. I am just a retail investor sharing my journey and experiences along the way. The content and opinions expressed in this video are for education and entertainment only. Do your own research and consider expert advice before making any investment decisions. All right, very important. I'm just your average schmuck on the YouTube, and you can believe me or not, but definitely don't use me for formal investment advice. Okay, so the first thing I'm going to tackle, for you guys that are subscribers, for those that are not subscribers and you're just watching this video, not knowing what the PIIverse channel is all about, you will not know about this. But for my 9,900 subscribers that actually answered a couple poll questions that I did about 5 days ago, I wanted to actually tackle them first. I did a video again about 4 or 5 days ago, can't remember exactly, that basically explained to all my subscribers and viewers what this Yieldmax reverse split event was. It likely, if you've never gone through a reverse split in covered call ETFs, it might have been pretty scary, especially when they said they were going to do a reverse 10-to-1 split. I mean, usually a reverse split, it's not good news, but it's basically not, I'm going to put the video up here. So, man, where's my finger? I'll put it up here. If you haven't seen the video and you want to watch it and you've never seen it before, I'll put the video up here so you can click on it and watch the details. But honestly, I hope I explained it properly what the reverse split is. Technically, a reverse split in its own right is nothing. It really is nothing. It basically is a administrative technical change or structure of your ETF holdings. So basically, if it's a 10-to-1, when you had 10, you'll now have 1, but nothing changes with regards to NAV and distributions. It's basically netted out. You get less shares and higher price, and the NAV stays the same, and that's why I want to talk about that. So, but the question is, it clearly is an indication. You don't do a reverse split if a cover call ETF is healthy. It's happening because something's going on with the ETF. Let's call it NAV erosion. It's typically an ETF that's been declining in value over the several months or years that it's existed. Coney is one of them, but there was 12 of them that were basically announced. And basically the ETF manager is worried that the price is getting so low that it could delist on the index, on the exchange. So what they do is they basically give you a reverse split and bring it back up in price. But that doesn't stop the underlying fundamental problem. If Coney and Alti and several of the ones had erosion issues before, a reverse split doesn't fix it. It just brings the price back up to a higher number so that it avoids a delisting, and it just starts back at a high number. Usually the way Yieldmax is doing it, they're trying to get you to that $40 to $60 price range. So that's why in some cases they were 5-to-1 splits, and in some cases they were 10-to-1 splits. They were trying to restructure it and reset it so that the price is back around the $40 to $60 range, approximately. And now basically, if it keeps eroding, it's going to keep eroding from the new $50 mark. So it's going to start trickling down. I'm hoping that usually this is a shot across the bow for the ETF manager to say, you know what, this is not good for our PR. This is not good for our reputation. I talked about it in the video that it usually hurts. A reverse split, of course, a reverse split technically hurts an ETF manager, in my opinion, more than anybody, because it's bad PR. ETF clients and investors of their ETFs will start doing outflows and selling their stuff, or maybe avoiding buying new ones. And that was the purpose for my poll questions that I asked about 5 days ago. I asked 2 questions, and you guys did respond really well. I had over 100, almost 200 responses on one of the questions, and I had over almost 400 or something on the second one. So I want to go through the questions. I'm actually pretty pleasantly surprised at some of the responses, because a lot of people, when they hear about reverse splits, they really go like all out. This is toxic. I'm getting out of here and blah, blah, blah. But you got to have a little bit more nuance when you're looking at reverse splits and actually think things more critically. And so I was happy to see some of the results. So let's go through those questions. I'm going to open up the first poll question. I'm going to put it right here. Hang on a second. Okay, so this one here was the first question. It's a little fake, so a little faded, so I'll read it out. It had 198 respondents, and the question was, with the Yieldmax reverse splits, if you hold any of the 12 cover call ETFs in your portfolios, or your plans, I said, but in your portfolios. So I'm asking the question to those of my subscribers or viewers that's seen the poll and said, if I'm already holding one of these 12, what am I going to do? My first question is, or my first option is to hold and keep collecting the distributions, even as they keep eroding. If they keep eroding, I'm still going to stay with them. The second one was, no, not only am I going to keep just stick with it, I'm going to actually do some DCA grow. I'm going to grow the position because they're at even lower prices. So I'm going to DCA so I can get more at much lower prices. And the third one was, I've had enough of this. I'm selling out. I'm going to capitalize my losses and take whatever remaining NAV that happens on the sale, and I'm going to go look elsewhere. I was actually pleasantly surprised that there must be a lot of, well, let's go, I won't say purist, but quite loyal passive income investors in my community, because the response that I should have seen the most as an answer was the one that happened. 58% of you that actually still hold one of these 12 that are going to reverse split to have basically said, I'm staying with them. I don't like it. Again, I hold 2 of them myself. I don't like it. Nobody wants to see a reverse split. But now that the reverse split happens, what does it really mean for me as an income investor holding an eroding cover call? In my case, I have Alti and Coney. Is it a knee-jerk reaction to sell out, and then basically just capitalize the loss I've had? Again, on my Coney, I'm down now about 72%. But why am I holding on? Because I would have been a respondent with number 1, and that is, I would say, you know what, at the end of the day, Selling out basically capitalizes it. You're only going to get a portion. Like, let's see me. I'm only going to get under 30% of my NAV back. And then basically from that, where am I going to go with it? Again, if I want to find another cover call ETF that has the same yield, I'm going to have to try to find one with that remaining little bit of NAV and find another 90% yielder or 85% yielder, whatever that yield is. You can't just turn around and say, I'm going to put it into a 30% and the stuff. You're really not going to get, you're really going to see a drop in your distributions. So this really resonated with me great, that people said, you know what, at the end of the day, the strategy is buy and hold. And I can buy and hold right until this thing finally, milk it right down to where it ends. A good news is, and we're going to talk about it later, there's the thing called house money status. Even though your NAV is eroding in, let's call it unrealized gains, because this is unrealized losses. It's unrealized. It means you haven't lost anything until you actually sell it. But what it's doing every month is still paying you income. And I'll give you a good example of it is my Coney, which is down 72%. Yeah, I can sell it and realize that capital loss and then try to push it somewhere else. But I can also keep it, because here's the thing. My Coney is in what's called house money status, and we'll talk about that later. And right now, every penny that Coney pays me in distributions, even if it's declining and diminishing every month, like, maybe it's $1,000 this month and next month it's $900 and next time it's $850. At the end of the day, it's pure profit for me, because for me, I've already reached house money status on it, and we'll explain what that means. So I'm glad to see the results here. I was actually interesting to see 13% of you said that you would actually DCA grow it and try to actually build on that position. Interesting. I don't know for me if I would do that. But again, I'm not saying it's wrong. The reason I do it, and I'm going to explain, actually, I'm not going to let the cat out of the bag. I'm going to explain to you later why I wouldn't do it for these guys. But it's definitely an option to follow. Okay. Because the other thing is, Yieldmax might decide that, hey, I've had enough. I got to fix this problem. I don't know if they can fix it. Maybe it's a fundamental problem with their use of synthetics, that it just doesn't allow it to stop the NAV erosion, or if it's just poor fund management, active management decisions that they've made. But what happens if they do fix it? Well, the people that will be laughing the last will be the ones that have been DCA growing it and buying these, alties at their much lower prices, and the yield is the same, because when you're buying at that lower price, you're maintaining that yield, but at that lower price. And then 30% of you said, I'm selling it, I'm capitalizing my losses, I've had enough of Yieldmax, I'm going somewhere else. Again, I'm not saying there's anything wrong with that. Again, it's not a buy and hold strategy that I believe in, but I can understand why some people say, you know what, I've had enough of this. I just want to clean the sheets. I want to go into something that's more stable. I've learned my lesson on these NAV eroders from Yieldmax, and I want to move something to more stable. And so you're moving on to something else. Totally understandable. So anyway, that was my response there. I'm curious when people ask, when you're writing comments in this video, what are your thoughts about what you saw from the results of this survey? All right, the second question was a more broad question to those that don't just hold it, but basically are just cover call ETF income investors. So my question here on number 2 to all of you, and I had 341 respondents, so it's a pretty good survey response. If you are a cover call ETF investor, which I'm thinking most of you are that are watching this, what are your plans regarding Yieldmax products? So let's say you've never had a Yieldmax product, or you have them but not the same ones. So I asked 4 different options and to see what you guys would say. The first one was, I hold or still consider, I hold or I will still consider Yieldmax cover call ETFs in the future. And you said 28% of you said that, I already hold it. For example, I do hold 5 others. So I do have a lot of them. I would be in that camp that says, yes, I still hold them. So 28% of you said that you hold them, or even if you don't hold them, you would still consider buying them. You wouldn't throw the baby out with the bathwater if they have some good options. Maybe, and they do. They've got these new Target 20s that are coming out. You might turn around and say, look, I'm not going to say all of Yieldmax products are bad. I'm just going to evaluate each one, see the situation they're in. I think that's a very prudent decision. or option, because you should never just throw the baby out with the bathwater. Right now, they aren't looking good. They've got a very bad PR, but they do have a large contingent of cover call ETFs, and they are learning their lessons. And I think these target 20s that are coming out are basically part of their, how do I move past these ultra yielders and try to offer products for those that don't want NAV erosion and want a more stable NAV and a more stable distribution. So yeah, I like the fact that people, 28% of you said you'd still consider them as an option. The second one was, I hold and still are considering holding, but not the reverse splitting ETFs. So what I was basically said, most of you said that you would avoid any one that has already had a reverse split. Only 9% of you said that you would consider Yieldmax products, but you would avoid the eroders. What that's telling me is that if you're looking at Yieldmax, there's very few of you that would actually throw the eroding cover call ETFs out and never invest in them again. Most of you that said that you would consider Yieldmax would still actually consider them as part of the catalog, and say you might even consider a Coney even now. So that was the difference between the 28 and the 9. The third one was, I plan to close all my positions over time. 32% of you said that, you know what, I've had enough of it. I would be planning on basically closing them out or reducing them. I do have a taste of this one because I actually did reduce my Coney position. I will not be totally closing out my position, but I did reduce it a little. I removed my Coney position out of my 2 TFSAs, but I'm not in any rush to get rid of any more. I'm more the guy that's going to be sticking around. So this would be, I sort of touched this one a little, but no, but so it looks like 32% of you, or 1/3 of the respondents, are basically saying, and again, I'm a very small respondents population, but this is not good news for someone like Yieldmax that's basically feeding into what I'm saying, which is that this is bad PR. A reverse split is bad PR for any company that has to announce it, and I think Yieldmax knows that. They're going to have to respond somehow. They're going to have to respond to to restore their reputation and fix things, and I don't know how they're going to do it, but this is the reason they have to do it, because 32% of you said, I'm going to start shutting down my positions that I already have. That is the outflow issue that they've got. The last one is the other one I brought up, and that's another 31%, is I don't hold any Yieldmax at all, and I sure will not be considering Yieldmax from now on. After this, that's it. I've had enough. Well, if you got 30% that hold them and are looking at closing them down, and you got another 31% that said, I don't hold them, but I will never consider a Yieldmax product again. Again, this feeds exactly into what I was saying, which says a reverse split incident is not the worst. Person that get hurt by that is the ETF manager themselves, because the investors will just say, I don't have confidence in you, I'm walking away, or I don't have confidence in you and I'm not coming in. So the inflows reduce and the outflows increase. So these are two bad things. Not shocking that these were the two right here. All right, I tend to be personally still in the first option, but I'd be more selective in picking what I want to pick. I don't think I'd pick any more of the, I might even say I wouldn't pick any of the eroders. So I might actually be more the number 2. I don't think I'd be buying more of the eroding ones, but I would be looking at the other ones if they suit my needs. Maybe the target 20s, we'll see. For American investors, again, I should talk to the American investors. The target 20s, even though, again, we're talking about Yieldmax with a bit of a bad reputation now, the target 20s might be an answer towards a potential future core position, because the target 20 is a lot more. We're gonna cap our target yields to about 20% and stuff like that. Again, I haven't researched them much, but usually when someone says like a target 20 or a target 25 or whatever, that means they're really going to not go for the maximum yield. They're going to hold it at 20. It usually means you're going to have a much more stable NAV, and you've got a much more, basically a much more reliable distribution. So for my American investors that are looking for a core position, I'm not saying that you have to or you should really seriously look at them, but I think you should consider them, because these might be good potential candidates for your core position. And we'll talk about the core position versus ultra yielders. Okay? So anyways, that's it for this question. I'm very curious. Have your comments posted in it. Tell me what you're thinking about. What are your thoughts about the responses? And I know there was some already in the comments. The comments are in my posts, so you can take a look at that. Okay, I'm going to get out of these. Hang on here. And so the next question that I've brought up is basically somebody brought a question, and you know, it's a good question. It still relates to the reverse split. Someone brought up the question is, you talked about everything on how does a reverse split affect NAV, how does it affect price, how does it affect distributions, but you never answered the question on how does it affect my book NAV. So what happens with book NAV? I'm just going to keep it in my head here. With book NAV, if you bought, let's say, Coney at $20, so if your average cost price of Coney is $20, mine's around that too. I think that's about $21, $22. That is my book cost on my units. Basically, it multiplies by 10 like everything else multiplies by 10. So if your book cost was 20, your book cost will now be 200 because your book cost was up there. So because when your current NAV is multiplied by 10, and let's say you're only at $6, that means your current NAV is moving up to 60, but your book NAV is at 200. So everything stays about the same. You're still down like 60, 70%. You know what I mean? So keep that in mind. Book NAV after right after the reverse split. If you are maintaining spreadsheets and stuff like I have, unfortunately, I have to go through these. I'm going to have to recalculate my book NAV because my book NAV says $20 for Coney or 21, and I'm going to have to multiply it by 10 so that I can get it up to that new price, right? The new cost price. So that was my question with regards to the person that asked how is book NAV impacted by a reverse split? Question 3. How does current NAV fluctuations affect distributions? So I was asked a couple times this question is like, you know, Perry, you say you're not worried about NAV. Like, I'm not worried about NAV declining or dropping. The people are taking that out of context. Everybody cares about their NAV declining. I don't want to see my portfolio's current NAV decline. What I'm trying to say is that unlike a growth investor, where NAV appreciation is their number one priority, that is what they live for. They're looking to appreciate their unrealized gains, and their NAV needs to appreciate, because that's literally what a growth investor's whole life is all about, is appreciating NAV so that they have a bigger and bigger wealth position over the years and decades, because at the end of the day, when they finally do decide to retire, they now have a $6 million unrealized NAV that they can now start consuming off of it. But as an income investor, that appreciating NAV is not as critical, because literally every month, your portfolio, your covered call ETFs in your portfolio are capitalizing your gains, and you're capitalizing your NAV into income. So if my NAV stayed at flat for the next 15, 20 years, I'd be happy. A flat NAV is great. If you do, but of course we can't ask for a flat NAV. Especially for me, that I hold a large percentage of ultra yielding covered call ETFs, which do generally create what's called NAV lag, and NAV erosion. So Coney is NAV erosion. I'm going to put a video up here for some people are like, well, what's the difference between NAV lag and NAV erosion? So again, I'm going to put a video right here. If you want to know what I'm talking about when I talk about what is the difference between NAV erosion and NAV lag, and actually NAV growth in a covered call ETF or a high yielding income portfolio, watch this video. It will actually go in detail what is the difference between erosion, lag, and growth. And it'll also explain what's the difference between erosion and just NAV decline. And so do that. So anyways, so getting back to the question, how does current NAV fluctuations affect my distributions? Generally speaking, and this is not a rule one-to-one, generally speaking, as NAV declines, you will generally see your monthly distribution income drop with it. When I saw the experience back in the Liberation Day, early 2025, when basically the markets dropped, my portfolio NAV dropped almost $300,000. So it dropped pretty good. What I noticed basically is that it dropped about the equivalent. My distributions dropped as well. So my distributions dropped around 20%. And the NASDAQ dropped around 20%. So not shocking that my distributions dropped equal to about what the NASDAQ would do, because you got to remember that covered call ETFs are always, for the most part, a big number of them are following the more volatile, the higher IV, the more tech volatility ones. And those are normally found in the NASDAQ. So maybe the S&P only went down, say, 16, 17%. I'm just using that arbitrary number. I think it was about that much. Whereas the NASDAQ went down even more, like 18 or 20%. And my distributions in that time went down about the same way. That is not shocking. And the reason it's not shocking is, first of all, the underlying, obviously the NAV dropped because the underlying stocks went down that fast, and that's what caused the NAV to drop. But when you're writing covered call contracts on an underlying or on a stock or a position that's actually dropped in its share price, you're going to get less income from it, because the lower the price, the lower the contracts. Generally speaking, the lower that they're going to get money out of that contract that they write for a lower priced share. It's hard to say. If I have a $200,000 car and I write an insurance policy on it, the policy's value is going to be a lot more than if that car is only $100,000 or $50,000. So you can't. An insurance writer will not get as much money on a vehicle that's dropping in price. And that's sort of what's happening in contracts. So as the NAV or as the underlying stocks inside these covered call ETFs drop in value, the contracts that are the covered call contracts they're writing on it will also drop in proceeds that they can generate from that. So that's the one thing. Now that is not 100%. So I don't write that in stone. But because there's also that an underlying stock that's extremely volatile, it will also increase the proceeds or the value of those contracts. So it all depends, but generally speaking, as distributions drop, as NAV drops, so will distributions drop. So again, I'm going to repeat myself. I do care that my NAV is dropping, but it's not like it's not the number one goal for my life to say that I have to have NAV increase or keep stable. I can tolerate it dropping because I know when the NAV returns and the markets go back up, that basically my distributions will go up. So it's basically the boats float up with the rising ocean and the boats go down with the lowering ocean. So for you people that have never experienced it before, if we're going into this incoming down cycle, market down cycle, and you see your NAV, let's say your NAV is at 200,000 and it drops to about 160,000, whatever, expect that percentage drop to also drop your distributions about that much. I hope that helps, because people are like, well, geez, my NAV's going down, but why are my distributions going up? That's generally why it happens. Expect that it basically tracks. Distributions drop with NAV drops, and distributions go up with NAV rises. So that's sort of it. But again, not cast in stone, because there are other factors also impact distribution that are paid out. The biggest one is IV. It's implied volatility. That is one of the biggest ones that affect distribution payouts. Okay, question number 4. Explain the house money concept in income investing. So I did say earlier that my Coney has reached that beloved, and I'm going to call it beloved because it's a rare feat for a covered call ETF to reach what's called house money status. Don't look it up on the internet. That basically is a technical financial term. It's a nickname that myself, and I know it came from other ones, like Retire on Dividends kept using it. I used to follow him for over a year, and he always called it house money status. What it is, it's a nickname we use, and it basically, so to say it generally, what it means is that if you've invested, let's say $100,000, so your book value for your investments, let's say it's Coney. Let's say I bought $100,000 worth and my book NAV on my Coney is at $100,000. And let's say that it has an amazing yield, and it did have amazing yield, and it paid out crazy numbers like 80, 90% yield for the first year, year and a half and stuff like that. And let's say after a year and a half, well, like almost 2 years, Coney has paid out over $110,000 in distributions. When the amount of distributions or the capitalized income, so I'm going to talk about capitalized income. So every time you pay out a distribution, the fund manager is basically giving you a capitalized gain. It's giving you a capitalized income. It's no more non-realized or unrealized. It is now realized because you get cash in your pocket. Those distributions, if they exceed your book value, you are now in house money status. That means that you've basically fully recovered your entire investment. So now, even if Coney, and I'm going to use Coney for my example before, even now, and I am, my Coney is in house money status. So even if Coney continues to do its erosion, which it has been doing, I don't expect it to stop doing it because we'll see if Yieldmax will fix it, but I doubt they do. Even if it slowly continues to erode and goes down, you know, it'll go up to like $65 and then it goes to 64 and then 60 and then 59. It will continue paying distributions, but every penny that it pays out in distribution is house money. And the reason is because it's beyond what I paid for my investment. It is now 100% pure capitalized profit because I've already paid for my entire investment, and literally Coney could blow off the face of the earth. I will lose nothing. Matter of fact, I will gain money because not only did I have my whole investment paid off by distributions, I'm actually making money every time it pays another month. So next month when Coney, or next week when Coney gives me another $500 or $200, it's $200 more than my book value. So that's what house money status is. It's a coveted status. Not many investors will reach that status unless you hold it for a long period of time. The nice thing about house money status is if you buy an investment, a covered call ETF, and you hold it long enough, eventually you will reach house money status because it doesn't matter what your NAV, your book NAV is anymore. Every time it pays a distribution, that is a net increase towards house money status. And eventually, if you wait 5 years and say you have a 20% yield and you wait 5 years, if you don't do anything different and if the yield stays at 20% for the entire in 5 years, you will reach house money status on that cover call ETF because it says 20% a year paying it. So after the 5th year, it will pay its 5th 20% annual yield. So in 5 years, that cover call ETF will reach house money status. And if it continues on, and I'm going to use something like HYLD or HDIV or ENCL, even if they're running at 17 or 18% yields, sooner or later, they're going to reach house money status. And if they are stable and they're reaching house money status, that means they're just going to keep on paying infinitum. And I'm going to say, I hate to, like an annuity, I know it's not an annuity, but it's just going to keep on paying way past its house money status. It becomes free 100% profit. And that's what house money status is. That's why it's a very interesting metric to follow and track. It's something that you want to hope to eventually attain for all your covered all ETFs. And that's why buy and hold is such a coveted rule in passive income investing. Because if you hold these things long enough, even the ones that you don't want to see it, but even the ones that erode, if you hold it long enough, it will get to and eventually reach house money status. It could take years, or it could take only a 1 year, or it could be like 20 years. It doesn't matter. But it's always moving towards house money status because you're always capitalizing those incomes every time it pays. Okay. Question 5. Somebody just asked me this question, and I'm surprised that someone didn't ask me this earlier, but I got asked the question is like, okay, Perry, I know you're 90% an income investor, but you have these 3 stocks you hold. One of them that, of course, you talk about a lot, which is my darling, my baby, ATH, Athabasca Oil, which, by the way, coincidentally enough, this morning, my Athabasca broke a milestone I thought I'd never see ever. It broke $8 a share. I've held it for 3 years. I never thought in my life I'd ever see my share, the Athabasca shares, hit $8. It did. So I'm happy as a clam because it did. It went back down after that, but its intraday trading actually reached a new modern day all-time high of $8 a share. It's the guy I talk about a lot. But people turned around and said, well, Perry, you never talk about your other two, PEI and HMR. So PEI and HMR, PEI is a very, I'll call it a micro cap oil company in Alberta. I think Alberta and Saskatchewan, they're in that area. They literally were on death's door. Like I've had this PEI down to almost 2.5 cents at one time. I'm in it for 6 cents. It literally is an extremely high risk penny stock. I hold it. The only reason I actually am very interested in it and I hold it, I'm hoping someday PEI it will never be like Athabasca, but I'm hoping that PEI is going to be what they refer to as a torque play. That next home run where basically that 14-cent stock will turn into a $2 stock. The reason I'm bringing that up is because Athabasca 5 years ago was a 14-cent stock. It is up 5,385% since 5 years ago. I'm sort of dreaming. I want to get in this time for a really low entry point. Please, nobody follow me. These are extremely high risk. There's an 80%, 90% chance it will never become anything more than the penny stock that it is. So please, this is my gambling. This is me rolling the dice. I'm just telling you what it is. It's called PEI. The reason I actually got interested in it is because one of the oil analysts and the oil engineers in Alberta that I watched hours and hours of his videos on everything on how to pump oil. And basically, I learned everything about the oil industry because when I learned about Athabasca, I wanted to learn exactly how it works. So I watched hours and hours of his videos. His name is Shubham Garg. He ended up becoming the CEO of this company. And I have so much respect for him that I thought if there's somebody that can turn this real, basically on the death's door loser back, it's going to be Shubham. Again, I hope he does it, and I think he will. The reason is this oil company has a lot of old derelict wells that have dried out. And there's this thing called enhanced oil recovery techniques that you could sort of breathe new life into them. And Shubham was really into this and knew this stuff. So that's why I bought into it. I've got 100,000 shares of this one. So, and again, maybe for a whopping $6,000. So that's that one. The other one that I have is HMR, Home Run Resources. I learned interest into this one because there was a YouTuber that was really a technical trader that I've watched all his videos. I liked his daily videos on watching how the markets play. But he fell in love with this thing called HMR, and I started like, well, if he likes it, he really watches the technical side. What's he interested in? I started listening to it and basically they're a Canadian company that basically does silica sand type of extraction. They mine sand and get silica, and they've come into some new technologies that they want to move into for high purity silica glass, whatever. They bought some properties in Brazil and whatever. Anyways, another penny stock. It's currently only at 85, 86 cents. Another one of these that I'm hoping is going to be a high risk but high torque win sometime in the future. It had me excited once because I bought it at 48 cents and went all the way to 270. Now it's back to 85. So again, that's what those two are. Don't even look at them. Honestly, I would rather you guys say don't touch them. I don't recommend them at all. They are my gambling stocks, and I use it because I'm hoping someday one of the two of them will just take off. There you go. So that's my thing. Again, warning, do not touch them unless you absolutely know what you're doing. Don't touch them. All right, question 6. How do I use an ETF catalog in my strategy? So some people were, so what is an ETF catalog? So if you guys watched my main income portfolio strategy, and I might as well do this here. There's going to be a video here for anyone who's never seen my main portfolio strategy on how I structure my entire high yielding income portfolio to generate around 35, 38% average yield. The video is up here. You can click it if you want. For my subscribers, I'm sure many of you already seen it. But inside that video, I talk about an ETF catalog. So what I do is I have currently 35, I'm not going to talk about my 3 stocks, they don't count. I have currently 35 cover call ETFs that are in what I refer to my catalog. I build a catalog so that I have 6 accounts. I have 4 RIFs and I have 2 TFSAs, and they all basically, the way it works is any one of those 6 accounts can use any of the ETFs in my catalog. I make a decision after a lot of research and after a hoeing and humming and seeing, will this fit into my strategy? Do I need a little bit more diversification? Like, for example, I'll say like Broadcom, Roundhill is AVGW, I think it is. Yeah, I think it's AVGW. It's like, oh, okay, I'm interested in that one because I don't have that'd be adding to my diversity. I don't have anything from Broadcom. So if I decide that there's a cover call ETF that I like, I've done some research and I'd like to actually start buying them in my accounts, I do the research and I say, okay, I'm adding it to my ETF catalog. Once it's in my ETF catalog, in my strategy, any one of my 6 accounts can then say, okay, I'm going to buy some of that one. And I over time, I will DCA and I'll reinvest and buy into and start opening positions of that ETF in the catalog. As long as an ETF is in the catalog, any one of my 6 accounts can buy it. The reason I like the concept of an ETF catalog is because it gives me some discipline to say, is it worth me putting this ETF in my catalog so that my portfolio can use it? It's more of a discipline thing. So I like the idea of looking at the catalog saying, okay, I'm a little low on the S&P. Here's my catalog of 35 cover call ETFs. I only have 2 that basically are using the S&P as part of its cover call ETF strategy. So I might turn around and say, I want to maybe build up more and I want to have a 3rd one so I can more diversification amongst them. So that is what an ETF catalog is. I prefer doing it as opposed to just randomly saying, I think my RSP is going to have that one. Oh, I think my TFSA is going to have that one. I like a strategy of knowing that they are all feeding from a catalog that I've done research on, and then any one of my accounts are safe in using them, and that's what I do. For the same reason, my catalog is always dynamically groomed. It's dynamically growing. I used to have my catalog at 25 cover call ETFs. They're now at 35. Over time, I might turn around and say, you know what? Maybe I will close some of my positions in Yieldmax, and maybe I'll bring it down to 33 cover call ETFs. So, but once I decide I want to pull a cover call ETF out of a catalog, I have to then effectively then go through all my accounts and start closing their positions. It will not, a cover call ETF will not leave my catalog until all my accounts have closed their positions for that cover call ETF. I'm anal. I like structure. Many of you guys may say, nah, that's too much for me. I don't want to do that. So that is what I have referred to as an ETF catalog. Again, look at my strategy video. It will give you more detail on it. All right. Another one I wanted to bring up, and I'm going to hang on. Before I do that, I want to find it before I open it up here. Okay. So I'm going to open up oh, darn it. It's moving around too much. I apologize, people. I'm going to go into my YouTube channel, and I'm actually going to talk about this topic. So number 7 is U.S. covered call ETF equivalents to popular Canadian covered call ETFs. All right, so let me go over to my web browser. There's a question here. So I posted this. So actually, just right below it, I had a great 2-hour podcast with Paul on Better Call Paul and myself. And we talked about basically had a coffee chat like I'm having now, but it was over 2 hours long. I asked Paul a question because he does follow the ETFs a lot more closely than I do. I only follow the cover call ETFs that I believe belong in my catalog. So a lot of American subscribers to my channel keep asking me, Perry, you keep talking about these Canadian cover call ETFs, how amazing they are, how they make up your core and your base, and you keep on mentioning them. But as an American, I don't have easy or any access to them. Give me some of these, give me some US equivalents of these kind of cover call ETFs that are out there. And honestly, I found it a little hard to find or to think of some of them, because a lot of the American cover call ETFs are either too conservative, they're almost considered growth, and they have basically yields under 10%, some 5 or 7%, or they go the other direction and they're 30% plus, or they're too aggressive and they experience NAV lag and NAV erosion. So I wanted to ask Paul that question. So for my American followers and subscribers, please go to my podcast, my posts. And there's a post from, it says it's 4 days ago, but it's in here. I said, for all my American investors, click that link. It will actually, this link here, the bottom link here, click, oops, sorry. The bottom link here, let me see if I can, there's my mouse. So in this question here, I had about a 5-minute or 10-minute conversation with Paul on what are some good American cover call ETFs with a good, relatively stable or stable NAV and good distribution options. And so please, for those Americans that are asking me the question on what are some good US equivalents, please go to this post here. And it basically says, for all my American investors, find that. Click this bottom link here. It will take you to the point of the Perry and Paul's coffee chat and give you about a 10-minute conversation of what we thought were some really good potential candidates. Okay. In addition to those, I think we even included the Yieldmax Target 20 as some of them to consider. So keep those in mind. I'm also going to, while we're on this topic, because this is very new, I'm just go over here. I brought this up a few days ago, or a couple days ago. These just came out, actually GRNI just basically was released this week. It sounds promising. If not, again, the problem is that they didn't give any details on what its yield is going to be like. Is it only going to be 5%, 10%, or is it going to be 20? I don't know. I'm going to guess it's not going to be that great. Great. It's not going to be high. It's going to be likely under 20%, I'm guessing. The reason is that these are called the granny shots. These are, they're writing cover call income contracts on a set of large cap and small mid caps, but a lot of them are big, stable companies or moderate companies. I anticipate that there's not going to be as much volatility, but I have a feeling that they're really going to focus on stable NAV, maybe even growing NAV, and stable income. Again, I don't know much more about them. I just learned about them this week. So I'll see what it means. There's a point at which if the yield is too low and it's an American cover call ETF, Canadians, it may not be worth it for a Canadian to buy into them because of the exchange rate, stuff like that. We'll see. If it might be better just to stay to the native Canadian ones if the yield is too small, but we'll see. But definitely this might be something for you Americans. Keep your eyes on this one. I'm not recommending you buy them unless you felt you've done your own research on them, but keep your eyes on that one. I think these might be some candidates to add into that. What is a good set of core holdings for your portfolio? And when I say core, we're going to talk about that. Okay. Related to that, I'm going to bring up this question here. Let me see. Okay, so I'm going to answer question 10 first before I go back. So question 10 said, Perry, you talk about core versus what I'll call income juicers in your portfolio. So my portfolio holds like 35 covered call ETFs. Hang on, let me go back to my face here. So my portfolio is highly distributed, and the way it's going to be successful, and why I believe my portfolio is stable even when the markets are down, is that I basically take a position where at least 50% of my portfolio uses what's called conservative, stable NAV, stable distribution cover call ETFs. Again, a lot of them, in my opinion, are my Canadian ones. And that's why a lot of American subscribers are asking me, Perry, what are the US equivalents of them? See, these are what I call my my core or my base cover call ETFs. So these would be the ones that make up about 40 to 60%. You decide based on your risk tolerance how much you want. But they would make up, let's say, at least 50% of your entire portfolio NAV. And again, their purpose is to hold the boat steady. They're going to give you a very solid, very consistent NAV. Chances are they won't erode at all. They'll actually increase because they're so stable. But at minimum, they'll stay flat. They'll pay you a very stable distribution. The Canadian ones that I have are so stable that it's boring. It's like 17, 17, 17. And then eventually I'll go, okay, 17.2. And so anything that moves is very stable. Those are what I call my core base covered call ETFs. And I believe you should have at least 50% of them in your portfolio. Then I refer to the other 50% as my income juicers, my ultra yielders. And because I have a base of core cover call ETFs that protect my base and make sure that I have a good solid income base coming in, I use the other 50% to buy into my ultra yielders, the ones that can take the risks, take the chances. And they're the ones like the ones generating 40, 50, 70, 80, 90% yields on them. Now, they handle a different position. So in order to take those kind of risks, on the income juicers, I make sure, depending on how risky they are, that their target holding weight is very small. So you won't see any of them exceed, say, 3%. A lot of them are only at 2%, and some of the ones that are my newer ones, or the ones I don't trust yet, or the ones I think are too volatile or too risky, I'll put them down at 1.5%. So, but I have a lot of them. So basically I distribute the risk amongst several of them, like 15 or 20 of them, so that even if one, for example, our beloved Misty and MSTE, or my MSTY, which is really going for a dog's breakfast right now. But the nice part is I only hold 1.7% of MSTY. So I'm not losing sleep at night that Misty is down so much. It's down at the $7-8 range. I don't know what it's at right now. It's like, okay, it still pays. It still pays an income. It's not as great as it was. It's likely going to drop again on monthly income. Hopefully when MSTR or Bitcoin recovers, it'll come back up. But because those ultra yielders are held at such small target holding weights, I don't worry about it. I'm able to tap into them when they're screaming, but when they're not screaming and they're actually hurting, I don't worry about them that much because it's not that much of my entire portfolio. So that is when I talk about my NAV base, my portfolio base versus my portfolio income juicers or ultra yielders. All right. Okay, so now I'm going to go back on to question 8. Question 8 is, when do I DCA reinvest and when do I stop? So this is a mixture between science and gut feel. Because a lot of people say, well, you know what, we'll use Alti because it's our favorite problem child. So do I keep DCAing it? It keeps dropping, so I'm going to buy more, and I'm going to buy more, and I'm going to buy more. And some people are like, man, it's now at only $4. I can buy a ton more when I reinvest from my income. I can reinvest and I get a lot more, and then you find out it keeps going more. So some people have asked me the question, Perry, when do you stop? When do you DCA reinvest so that you can keep, reducing the cost of your investment? And when do you basically stop? My strategy is that every time, and if you again watch my main video on how I do my strategy, and I've talked about it several times in a lot of my other videos, I showed you my spreadsheet, and that I set a target holding weight for every covered call and every investment in my portfolio. Again, I have 35 of them, plus I have 3 stocks. Every one of them, if I showed you my spreadsheet, I don't want to do it right now because that just takes even more time. I set a target holding weight for every one of my covered call ETFs. So, for example, in Alti, I think my target holding weight for Alti is only 1.5% or 2%. Let's say it's 2%. I will DCA. I will decide if I should DCA, if the price is right or if the opportunity is right. I will DCA reinvest in Alti until I hit my target holding weight. When I reach my target holding weight, my priority is target holding weight over DCA. I will stop DCA investing on any covered call if it reaches my target holding weight. So for me, that's my answer. I stop when my target holding weight. So right now, Alti is at, and it actually is a little bit above its target holding weight. I will not be DCA investing in Alti anymore. It's at its 2% mark. You know what? It's not getting any more from me. I will use every time I have to reinvest, I look at my entire portfolio and I look at which of my covered call ETFs are under, their actual is under their target holding weight. So let's say HHIS has a target holding weight of 5%, and I'm currently at 4.5%. It becomes a potential candidate to do a DCA on that. So that's why I do not do DRIP. First of all, I can't because I'm retired and I don't want my money reinvested. It has to come out to pay my bills every day. But even if I wasn't retired, I would never drip. I don't personally like dripping because I like all my income from all 35 of my covered call ETFs to hit a big bucket. Then I build it up over, say, 2 or 3 weeks. And okay, I've got $12,000. Where am I going to reinvest? So that's why I don't drip. I'll look at it and say, you know what, HHIS, it's down 0.5%. I could put some in there, but I've noticed that HHIS's price is a little high. What else is, oh, look, ENCL, it's also underweight and it's actually at a good price. So I'll do an analysis each month to say which are underweight, and then of those that are underweight, which are one of the best deals and which account, or I may make a decision, say, you know what, my TFSAs don't have any of that holding. All my holding of covered call ETF is in my RIFs. So I might decide to increase and open positions in my TFSAs from my ETF catalog and say, and I just did that. I added WPay into my TFSA because I never had it. All my others do have it. That one didn't have it. So that is my answer to when do I DCA reinvest and when do I don't. Target weight determines when I stop DCAing into any of my covered call ETFs. As a follow-up, my target weight is not set in stone. Almost on a monthly basis, I review my target weights and say, you know what, based on the situation that's going on, I don't like the way that let's say the reverse splitting is going on, and I don't like the way the erosion is going with Coney, and I actually do like a new one called COIW. So I'll turn around and say, you know what, I'm going to lower Coney's holding weight, target holding weight to say 4% or 3%, and I'm going to give that that extra percent over to COIW. So I'm always rebalancing my target weight based on situations and analysis on which is the better one, so that I'm constantly making sure that my portfolio is well balanced and that my target weights are well distributed. And then finally, it was supposed to be number 10. It's going to be number 9. This is a question a lot of people are asking, especially now with the Yieldmax announcement on reverse splitting and what they think. So my question is number 9. What is my strategy for dealing with NAV eroders like Coney, like Alti, like several of the others? Should I sell them? Should I hold them? Should I DCA buy them? So I think we sort of answered that question at the beginning, but here's my position on it. Generally speaking, I am very loyal to the passive income investing strategy and philosophy. And I typically believe in a buy and hold. That now, buy and hold doesn't mean I'll buy and hold for no matter what. But I generally will turn around and say, I will buy and hold unless there's a reason why I need to exit a position. So for me, even if a NAV eroder keeps declining, and I have several examples of it. One day I'm going to create another video that's going to show you my portfolio up to date, show you how many of my covered call ETFs are actually 20, 35, 40% down on NAV. And I haven't sold almost any of them. They all stay because the priority for a passive income investor is to hold an income asset or a covered call ETF that constantly is generating monthly income into the income bucket. And even if Coney, which was very front loaded with heavy, beautiful distributions, has now over 2 years declined to be only paying a distribution of maybe about 30% of what it did, it's still 30% money coming in that it would not have if I got rid of it. So I will basically, for example, hold Coney until it dies, and it won't die. Like until it turns into an itty bitty little trickle. Somebody says, well, I'll hold it until it dies, and it won't, because as long as the underlying exists and hasn't delisted itself, Coney will constantly exist. It will just basically do another reverse split. If the erosion keeps happening, it will maybe a year from now reverse split again, and it'll become even smaller, and it'll go from a river to a stream to a creek down to a little trickle. but I'm just going to hold it. I mean, basically milk it right to its nth degree, because it doesn't owe me anything. I'm already at house money status. Remember, I told you all cover call calls eventually, all cover call ETFs will eventually reach house status if you hold them long enough. So I'll just keep on holding them. I don't have any plans to sell my eroders. I know this really bakes the noodles of growth investors. Like, why are you holding something that basically is at 70%, then 80% loss and 85% loss? And it's because at the end of the day, I'm focused on income generation. And basically that Coney is still paying me a monthly distribution every month. It's paid me my house money, so it doesn't owe me anything. I've already got my money out of it. All my investment's gone from it. So why sell it? Why capitalize my loss? For what reason? So that's my strategy. I'm not saying everyone else should do it. Some people still, again, there's that level of loyalty of, are you a true passive income investor, or are you sort of one that's sort of got a foot in the growth side and a foot on the income side? And if that's the case, you're going to be that individual that says, I've had enough. The NAV has dropped so much. I've lost so much on this thing. I'm going to sell it and get rid of this loser. If you're making those kind of statements, you're actually not, in my opinion, a real, loyal, entrenched passive income investor. And again, nothing wrong with that. You are more of a hybrid investor. You want to turn around and say, I want a little of the cake and I want to be able to eat it. I want the NAV stability and I want income. So if that's the situation, again, I'm not saying you're wrong. That means you're more of a hybrid investor. And so these things are going to bother you when you see one of the ultra yielders that are basically eroding and you're losing NAV on it. My recommendation to you is, if you are one of those hybrid investors that basically can't sleep at night because your Alti is down to $4 and you've lost about 80% of its NAV, you shouldn't be investing in ultra yielding cover call ETFs. You should really be focusing on conservative cover call ETFs, ones where their NAV is relatively stable. It only goes down because the underlying is down, so it has basically a NAV price box. But again, it's not for the person that is a hybrid investor, or it's surely not for somebody that's a growth investor. They would never like any of the ultra yielders. It's just absolutely the anti for them. So keep that in mind. If you can't sleep at night when Misty is down to $6, you have to ask yourself, are you truly a pure passive income investor? The other thing I also want to make sure, and I want to point this out just so as we're talking about this, I really recommend anybody that has passive income investing portfolio, or any portfolio for that matter, you should not be holding, unless you've got an investment that is so rock solid that it's almost like a GIC or a bond. You should not be holding large positions or large target holding weights, such as 30-40% on any one of them, especially in the cover call ETF space. And if you're investing in ultra yielders, there should be no Alti holder should be holding more than 4 or 5% in it. I know there's people that actually put almost their entire portfolio in it, or 30% of it. Again, not my game. That's not what I would do. I would not recommend anyone put any ultra yielders anything over a 5% holding weight. Matter of fact, someone like an Alti in that, it's called Alti for a reason. It focuses on underlyings that are the most ultra volatile. So it should be no holding more than 10 to 3%. So please keep that in mind for your own portfolio sustainability. Do that. All right. I think I've talked enough. I've definitely talked for an hour. Again, the chapter's in there. I'm going to put all the questions into the description. If you are not a subscriber and you've watched me for the first time, I please encourage you to please become a subscriber. I've got lots of videos and lots of things on passive income investing strategies. If you are a subscriber and you want some of the added perks, I've just recently, a week ago, created my new members only section called the Patrons and the PIIverse Pillar members that get access to my spreadsheets. They get access to my PDFs of my videos and several other things. So please look into maybe potentially joining as a member and maybe enjoying some of those if they actually suit your needs. And again, until next time, stay safe, stay investing, and I will see you in the PIIverse.